Hello, I'm Chris Pedersen, and this is Stock Watch for Wednesday, the 16th of October, 2024. All information is general advice and may not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. Here are a few market observations. First of all, last night the ASX closed at 8,318. This is a record high. No shocks to the economies around the world right now. US is strong. China is growing, not as fast as it has been historically, but it's still growing. So my view is basically steady as she goes, stay long equities. Here is a chart showing Standard & Poor's view of where the risk to equities going forward is. That dark blue line going sharply up, that's the Middle East. The orange line next down, which is declining a little bit, is China. Everything else you can ignore. Now, my view historically is that Middle East tension does not really impact global markets and their equity pricings. Here is a chart on China house prices year on year. Well, this is what we expect. It's getting weaker. Now, it's in negative territory in terms of growth rates. This is bad overall, indicating lack of confidence in the Chinese economy by Chinese themselves. Here is a chart on their savings rate, consuming rate, and investing rate. The line that's moving up is how much they're saving. How much they're investing is at the low end, the light blue. This is not good news. This is like Japan for a long time. The Chinese are saving all of their money. They don't want to spend it. They're not investing it. And the middle line, which is kind of going straight across, is the amount that they're consuming. Chinese government wants them to move into a consuming-based economy, more domestic consumption than relying on exports. But that's not really happening according to this chart. This is a disturbing chart. It shows confidence in the science behind global climate change. What we see is that the last bar chart down at the bottom is 2023. The black is those that don't believe scientists are really on top of what needs to be done. That is increasing. The dark blue shows confidence in scientists. This is a problem, it's a wake-up call, and this is a worry for Albanese in the election coming up. Now, this is a chart that I highly recommend that you save for posterity. This shows what happens when housing supply meets demand. This is Dallas, Texas, but this chart could be anywhere. It could be Sydney, it could be Phoenix, Arizona in the 1990s. When you have adequate supply of housing meeting the demand for housing, prices don't go up much. Now you see that spike and then come back down. That's COVID. I would ignore that. Smooth it out. Dallas, Texas has not had much of a price move ever since housing increased. This is a chart that shows U.S. public debt to GDP ratio. This is hypothesizing going forward based upon what the two candidates are promising. What you see is Donald Trump is the red, very high increase. Kamala Harris is increasing, not quite as much. And then if everything remains the same, what the increase is. All three of these lines are disturbing. Trump is extraordinarily disturbing. What is happening in the US is they're all making these promises about cutting taxes, spending money, yet they don't have the funding to do so. As a result, the interest payment that the US government is going to have to make is going to strangle their ability to maneuver. Right now, the interest payment in 2024 is $892 billion. The next biggest line item is the US military, and that's around $840 billion. The interest payment in 2025 is estimated to go up to $925 billion. With these numbers, that shows that nobody in the United States at the federal government level and in Congress is really concerned about the increase in debt. They're not doing anything about it. If the US government gets strangled, well, that hurts the rest of the world. 3 companies today. First one is Guzman and Gomez. They went public about 6 months ago. It's not a long-term chart. And it's had an extraordinary run. but I've looked at it ever since it floated. And I wanted to wait until there was some good numbers coming out and a little bit of a track record and past the August reporting period before I had a chart and drilled into it for viewers. This is what I found out. These estimates, by the way, are from UBS. Its market cap right now is $3.7 billion. A week ago it was $3.9 billion. It's declined some. UBS has a price target of $37. They raised it recently from $35. However, let's look at the numbers, see what the truth is going on here. Revenue growth from 2024 to 2027 is 26% per annum. Now, even though it wasn't public, they still have published audited accounts. Their earnings per share growth from 2025 to 2027 is 71% per annum. The reason I'm excluding 2024 earnings is because it's a low number, it distorts the figures. Then the dividend growth, they don't pay a dividend right now, but it's estimated by 2026 they will pay a dividend. And between 26 and 27, they estimate that the growth will be 76%. I don't really like going out to 2027. That's 3 years, a lot can happen. So I don't really consider that a real number to focus on. Shareholder equity growth, now this is important. It's only been 8%. That's surprising considering the above estimated growth rates. The PE on the 2027 earnings estimate of 47 cents is an extraordinarily large 78 times. The yield on the 2027 dividend estimate of 30 cents is 0.8%. Free cash flow is only 1%. The payout ratio when they start paying a dividend is going to be around 60%. So what is Guzman y Gomez? A lot of you know, but in case you don't, it's a Mexican quick serve restaurant. Now, quick serve restaurant, the symbol for that is QSR. It's getting popular. It's like McDonald's and other chains. They have strong growth. However, even using 2027 earnings estimate, it's too expensive. If I use the 2026 earnings estimate, the PE is over 100 times. The SSG, that is short for same store sales growth, is over 9%. So that's a good positive. Equity growth only 8% really worries me. Because it is so high on a PE basis, I rate it neutral. I have other concerns with Guzman y Gomez. One is, can they truly continue expanding as they have in Australia? It's a very Australianized version of Mexican food. I don't really think they can be popular in the United States because it goes against all the traditional norms. But if you just focus on Australia, I don't see that they can continue this growth rate with the menu that they have and the cost structure. Second company is Domino's Pizza. I watched this and have been following it for years. When it was going up and was trading in the stratosphere, as the chart says, I was very bearish on it. Well, let's take a look at where it is now at $36.76. Will it go up or will it go down further? These estimates again are from UBS, and currently Domino's Pizza has a market cap of $3.3 billion. The 12-month price target according to UBS is $33. They're a little bit on the low side. Some brokers are around $42, like Jardine and Goldman Sachs. Revenue growth, according to UBS, from 2024 to 2027 is only 2.9% per annum. Earnings per share growth in this period is 12%, and the dividend growth is 13% per annum. Now looking at the shareholder equity growth rate during this period, it is 6.4%. So these numbers are solid numbers. They're okay. The PE on the 2026 earnings estimate of $1.68 is 22 times. That's an okay PE also. The yield on the 2026 dividend estimate of $1.34 is 3.6%. So all of these numbers are just fine. The free cash flow is 3.5% and the payout ratio is 80%. Domino's Pizza, they have stores in Australia, New Zealand, Asia Pacific, like Singapore, Japan, and Europe. New store growth has stalled. What is helping them is an estimate that food costs are going to stabilize or ease from here. And they have 30 million more cost outs that they think they can implement without impacting the nature of their business or hurting their growth rate. I'm neutral. And the reason I'm neutral is there's so many companies that have better growth prospects. So my view is, why bother? Look for something else that has a higher probability of being successful. Third company is Incitec Pivot, IPL. It's trading right now at $2.98. It's a 5-year chart, and you can see it's been all over the place. Let's take a look at current numbers. These are from Goldman Sachs. First, it has a market cap of $5.8 billion. Goldman has a price target of $3.30. The revenue growth rate they have from 2024 to 2026 is negative 0.8% per annum. Earnings growth in this period is flat. Dividend growth in this period is flat. Shareholder equity growth, negative 4%. The PE on the 2026 earnings estimate of 19 cents is 16 times. And the yield on the 26 dividend estimate of 10 cents is 3.4%. It does have decent free cash flow at 7% and a payout ratio of 50. Incitec Pivot is a manufacturer of explosives for the mining sector and fertilizer for the agricultural sectors in Asia Pacific and the Americas. They have no growth. I'm neutral. The company historically has been a proven winner. Right now, it is hitting a wall. I will continue watching it, but for now, I'm neutral. As always, if you want to learn more about anything I covered, send an email request to stockwatch@fnn.com.au and direct it to me, Chris Pedersen, and I'll endeavor to get back to you. Hope you have a profitable week. Thank you.